Now, now, now we are starting A2 ratios. Okay. So we have financial efficiency ratios. Now these ratios, the name says itself that they evaluate the financial efficiency of a business, how efficient the business is running. So the whole idea of evaluating the efficiency of a business is through identifying the return on the investment. Okay, so how well are you getting a return on the investment? How well are you using your resources? Um, okay, now there's different things that you can use to what do you think, by the way? What ways can you kind of what do you think, what are the things that we're going to measure to evaluate how efficient a business could be?
Maybe the output.
Yes, very good. Output, close. So there's one way of evaluating, it's called inventory turnover. Your inventory turnover ratio records the number of times the inventory of a business is bought in and resold in a certain period of time. So how fast do you sell your inventory? So how many times do you reorder and how fast you sell it? So the whole idea is to have a very short period of time to hold on to inventory, make inventory, and sell inventory. Because the faster you do it, the more efficient you are. Okay, so this records the number of times okay, so the formula for this is the very first thing that you have to do is the first step is to calculate your average inventory. Your average inventory is simply your inventory at the start of the year plus inventory at the end of the year. That sum is going to be divided by 2. Okay. Once you have this, then you can calculate your rate of inventory turnover. That is cost of sales divided by average inventory. Okay.
Okay.
Do you have this written down?
I'm on rate of.
Okay.
Miss, what does IT stand for?
The what?
What does inventory?
Inventory turnover. Yeah.
Okay, done.
Now, I'll just add the practice question to that document of ours where you can calculate these. Do you want me to reshare the document with you, the ratios practice sheet?
Miss, it on classroom. On the classroom, right? Let me check.
Ratios. Did you get a chance to practice any of the questions on the other paper one, paper two questions I shared with you?
Yeah, I did.
Okay. There you go.
Miss, are you putting it on the practice worksheets?
Yes, our ratios practice sheet.
Okay. Miss, I can't find it.
Okay, I'll just reshare it with you so that you can get an email again.
Is it like, oh, it's By email?
Well, you search for it on Google Drive, you would find it, but just making it easier. I've reshared it. Now you can check your mail.
Okay, got it. You want me to do the last one, miss?
PLS and BSK, yes, financial efficiency ratios.
Okay. Miss, for PLS, I got 3.125. For BSK, I got 12.
3.125 and 12, absolutely. Now I want you to comment. Um, the so things that you need to know now. What do you think is better? Which business is doing better?
Mm. Oh, 1 second. BSK, no?
Yes, because
It has a higher rate of inventory turnover.
exactly. Yes, that's exactly what it is. So the result is not a percentage, but the number of times inventory turns over in the time period. That means their inventory turnover is 12 times in a year, while PLS is only 3 times pretty much. There's no such thing as 1.25, 0.125, although there is an answer, but um perhaps we can see that they're not selling their products very well. Now,
Miss, how do you know it's in a year? 12 times in a year?
because this was your data just for the entire year. The in Remember your average inventory at the start of
Oh,
the year. Yeah.
yeah.
So
Yeah.
this is your entire year's, right? Your next um aspect that you will see is called your trades receivables turnover. This evaluates the how long it actually takes for you as a business to take or recover your payment from your creditors or your debtors. So the ones you've given products on credit, how long or how quick do you collect or take your money, recover your money from them? Okay, because especially in the secondary sector, especially even in the primary sector, customers buy things in on credit. They don't pay you upfront because they're usually buying in larger quantities. They're your regular customers, so and so. So sometimes those debts turn into bad debt, right? So we want to avoid those, and how quick you are in recovering your financial payment. It obviously it really doesn't happen in service sector, especially if you're like a retail store, because you get your cash payment right away. But for your secondary and primary sector, this is involved where you've got your trade receivables. Okay, so this is your trade receive. Wow, got this one wrong. So your formula over here is pretty simple. That's your trade receivable ratio. So I'm just gonna write TRR, TRT for trade receivable turnover, and you do trade receivable divided by credit sales, the number of credit sales you've made in a particular 1 year, and you multiply it by 365. Okay. Um, Obviously the reason you do this is because you're evaluating your all of this is going to be your end of year evaluation. So it's always going to be calculation for the entire year. Okay. Trade receivable.
Miss, so a trade receivable is when a customer like gets a product but they haven't paid for it yet.
Yes, on credit.
Okay.
Have you written this down?
Yeah.
Okay, I've added the question on that document, same doc.
Miss, so revenue for year ending is the same thing as credit sales?
Yeah. You need to remember these alternate names because they do this in the exam and then you get completely confused.
Yeah. For PLS, I got 0.18. And for BSK, I got 0.156 or 0.16.
Did you multiply it by 365?
No,
Because it was a very funny number.
yeah, that's why I was like, it doesn't make sense. Miss, you know, my class in school is about to start critical path analysis,
Okay.
and we're finished with it, so I feel like better.
So you can, like be just act all gangster, be like, oh yeah, this is easy. Oh, you guys finding it difficult? You do that to them, and then they'll be like, oh, you're really smart.
I'll ask teacher if I could teach the class.
The best way to learn is to teach. When you teach something to someone, you're able to kind of reinforce the whole thing to yourself and you understand it better. There are so many things as a student in Cambridge syllabus. As a student, I did not understand, but when I started teaching it, it was a completely new revolution for me. So while my very first 2-3 years of teaching, I would teach it and I would discover that, hey, oh, this is how it was supposed to be done. I still wonder how I got an A myself. Must have been a nerd. I
No,
was a
miss.
nerd. I was a nerd. I still have my rough notebooks. I
It's
used to,
better to be a nerd than to just like suffer and get bad grades.
yeah. I'm still a nerd. My friends make fun of me.
Well, they're not true friends.
Oh, they're not.
Miss, I used to get really good grades when I used to live in Lebanon, and then I moved here, and then oh, I think I already told you the story. It got so bad.
Yeah. Um, I get it. It's initially it's the transition that really affects you. You feel like and you think that it doesn't affect you, but trust me that it does.
Yeah,
Um, it's
because
usually the transition and then the way the teacher teaches,
it's so much harder in Dubai.
the overall influence, the kind of people who are around you, all of that has a great influence on you.
Yeah,
Did you get
Miss,
your answer?
yeah, I got for PLS I got 65.7. Do we need to round it? Like, oh,
No, but this is fine. 65.7 is fine. It's okay.
okay. BSK I got a 56.94.
Okay, fine. Cool. So yeah, 65.7 and 57 days. All right. Now, when you look at this result, obviously the answer will vary business to business. There will be no right or wrong answer. Why? Because it depends on the kind of business it is. It depends on how sometimes a high result of trade receivable turnover may be deliberate by the management strategy. because you want to attract more customers and show them that hey, we give a long period of time for to borrow, and that way you kind of trap your customers. And trust me, upper management does this. It might sound very shallow, but this is how businesses run. Okay. um so what is the strategy to reduce the number of days of trade receivables is obviously yes, reduce your credit period, and customers should be asked to pay within a certain time period or a shorter time period. Drawback, customers might refuse to buy things from you because you're not offering a long period of credit to them. So, they might just move on to your competitors who are providing with a longer period of credit. So, this is also one aspect that you're competing with your competitors in. After that comes your trade receivable, trade payable is you now paying your products that you paying off for your products that you took on credit. So these are all your credit purchases. So it measures your credit purchases. Now, this would be the complete opposite. The longer you take to return the money, the better it is. Okay, because this way you're holding on to your money longer. Okay, so we have trades payable turnover is equals to trade payables divided by credit purchases into 365. Okay.
Okay, done.
Okay, perfect. I'm just going to add the question here. Trade payables turnover. I've just added that to the document.
For PLS, I got 58.4 and BSK 53.2.
Yep, absolutely. That's the correct answer. So now on the commenting, I'll just read what it says. BSK pays its suppliers more quickly than PLS. Both companies pay their suppliers more quickly than they receive payment from trade receivables. So now this is you comparing your trade receivables with your trade payables, which is also very important. In your exam, you could get a question where you might have to calculate both of these, and then you'll have to comment on these. So now this way you have to remember that there is a possible question on comparing the two. Okay, so you want to make sure that your trade receivable turnover ratio is low and your trade payables turnover is high. Okay, and when it compares with each other, you want it your trade payables turnover to be higher than your trade receivable turnover. This creates, if you look at this, both of these companies pay their suppliers quickly, more quickly than their trade receivables. Now this is going to create cash flow problems for them. Okay, so to avoid cash flow problems, I hope you're making a note of this. This is really important stuff for your commenting. Okay, so avoid, I'm just writing it here, you can make a connection. Avoid cash flow problems. You want to pay suppliers a bit later than the payments you receive. So paying suppliers more quickly than customers pay the business leads to a greater need of working capital finance. You'll need more regular day-to-day finances. Okay, although PLS takes much longer to pay its suppliers, it still has the same problem. It must find additional finance to recover the period. So you haven't even received the payment from your customers, and you're already making payment to your suppliers. How are you doing that? You're using your working capital or your savings to pay them. It's like somebody's borrowed something from you, and you will borrowed something from someone, and you haven't even received what you had borrowed, and you're already paying them. So how else would you pay other than paying out of your pocket? That means, what if that other person doesn't pay you back? Then you're in trouble, right? And you also don't want to, in a business, you don't want to spend out of your pocket. Okay. All right. Now, if you look at, okay, I want you to, when you are done with this lesson, I want you to later open Peter Simpson and read the evaluation points in the textbook. Okay. These are on page 768. Methods of improving financial efficiency ratios, methods of improving profitability, all of that. Okay. Because I'm moving on to the next ratio so that we get done with this topic. Okay. This is gearing ratio. How geared your business is, or this is simply, in simple words, how much do you owe? Okay, so it measures a firm's ability to which the capital of the business that we're using in the business right now is financed from debts. All right. The greater the reliance of a business on loan, the more highly geared. So obviously, the more amount of money that you've taken, the higher trouble, the more amount of trouble that you're in. You want to keep this at a minimum. Okay. The lower this is, the better it is, because it shows that it shows you're borrowing. shows your liabilities. And you want to keep that to a minimum. Your gearing ratio can be measured through non-current liabilities. In this gearing ratio, inventory turnover ratio, trade receivable ratio, these appear a lot in your paper 3. Divided by capital employed. Into 100. Okay. Wow, there is one more ratio left after this. I thought I'd be done. Once you're done writing this, I've added the question on the document.
Okay. For PLS Smith, I got 10 and VSK 40.
Yes, 10%. Don't forget the
Yes.
percentage sign. Okay. So we can see that BSK is very, 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 very dependent on the loans or borrowing. Okay. They are going to obviously struggle, while BLS is less dependent on your bank's loans finance. Okay. It's a less risky strategy. Especially if a business goes above 50%, then you're really, really stuck, because here you are, if you're above 50%, then you're basically just you're gonna struggle paying off the money, because if you're only making 40% profit and 50% is your money borrowed, what if you have to make that payment? How are you gonna pay it, right? Because your gearing is higher. So there you might struggle. And when debts have to, obviously they have to be paid back eventually, and if they're higher, then your existing profit, your revenue, your savings, then you're in deep trouble. Next is finally our final one, hopefully our final one. I'm hoping it's the final one, is our investment ratio. So this evaluates more, obviously this is for your limited companies, where you evaluate the different aspects for shareholders and your investors. So this is something that goes into your prospectus. Okay, this is something that is of particular interest.
I'm sorry if there's background noise.
Okay.
Can you hear anything?
Was it sudden? Has it been there since
No, Miss,
COVID?
it's just so loud outside, and I think my helper is vacuuming something.
Okay, let me see if it'll get better if I get on my table.
No,
That's
Miss,
where I usually teach from.
it's not from you, it's from me.
Oh, you
I was
made
saying
me get out of my
I
bed for no reason.
Miss, I'm sorry. No, I meant I'm sorry for my background noise because my helper is
Oh,
vacuuming.
oh no, I didn't hear any background noise. It was completely silent.
Okay, okay.
Yeah, and then I got used to the Lebanese household after that one scream. I heard once. Okay. Now that I've relocated anyway, I was being lazy at that time, didn't get out of bed.
Guess I'm
Okay,
also
so yeah, I mean, it's a bit of a struggle to get out after your afternoon nap.
yeah.
So your investment ratios are of particular interest to your existing shareholders. This data is shared with your shareholders in the financial in your prospectus, your potential investors. So this data is usually shared in the financial reports where they get a chance to see how much they're going to get, how many times that dividends will be paid to them, what is the share price, how much they're going to get in return, so on and so forth. So your first one is called your dividend yield ratio. First thing you're going to do is you're going to calculate your dividend per share. So for each share that you buy, what is the return that you're going to get? What is it that you should expect in return? So this is your total annual dividends. The dividends you give the dividends you give all around the year, the total amount, okay? Not the number of times, but the total amount. And then you divide it by the total number of issued shares. And then once you have that, you calculate your dividend yield ratio. That is done by dividend per share divided by the market's share price your dividend yield ratio actually measures, sorry, I forgot to tell you that earlier, it measures the percentage of a shareholder, percentage of the return a shareholder receives from the company. Okay.
Okay.
Um, let's see. Okay. I'll give you a question. This one is a little bit longer because you have to calculate different aspects first. So this is your number of share dividends, number of shares. We have dividend yield ratio. So the step one is to calculate your dividend per share. The next step is to calculate your dividend yield. Okay. Okay. Bad formatting here.
Oh, is this supposed to be like the other end of the table? It's like under.
Yes. So yeah, it's on the other end, but what happened? It disappeared.
I moved it
Oh.
to. Oh,
Okay, fine. Cool, cool.
oh my God. I'm not under.
Google Docs is not very user friendly.
It's okay. Okay, miss. So for the PLS of dividend per share, I got 0.15.
Did you multiply it by 100? Okay, dividend per share is 0.15. Yes, 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 yes. That's correct.
And then the dividend yield ratio is 10.
Perfect. Yes, yes, yep.
And then for BSK, the dividend per share is 0.7 and the dividend yield ratio is 7.
Perfect. Yep. So um this is telling us that obviously the people who've invested in PLS are getting a higher return on their investment than compared to BSK. That is a clear indication that they're getting a 10% off whatever they've invested in return. After this comes your dividend cover ratio, and then we have this is the last one, so let's just do it before the next class.
There's
The
another
next
ratio in
one
this?
is okay. We've got dividend cover ratio and price earning ratio. These both fall into your investment ratios. Okay, I won't give you practice question for that. I can add it on the document and then you can do it later. But I'll just explain those to you. Your dividend cover ratios is the number of times the share dividend is given. Okay, so it calculates the number of times the share dividends could be given. So the higher the number, the happier your shareholders are going to be. So the more times you give a dividend, the happier they will be. Okay, so dividend cover ratio is equals to profit of the year, whatever profit you've made in that year, divided by annual dividends. Okay,
Okay.
so this basically shows how you know the number of times basically you've paid your investors. Then comes your final one, which is your price earnings ratio. This shows this basically shows if this is higher, it demonstrates the trust, the confidence your investors, your shareholders have in you.
Hi, Miss.
Hey, I'm just finishing off.
Okay, no worries.
Haven't you? Okay. Is this our A2 class? This is our A2 class, right? So this shows their expectations, the expectations of your investors. Okay, this ratio highlights the expectation of the higher the expectation, obviously, the more trust it demonstrates. Okay, so first step will be you calculating your earnings per share. And how do you calculate that? That is profit of the year divided by number of shares you've issued. Oops, please ignore this. Okay, I'll just rewrite it. Number of shares issued. Once you have this data, you're going to calculate your price earnings ratio, which is market share price divided by earnings per share. Okay,
Miss, what is this for?
this is your price earning ratio. So your first step is you calculating earnings per share. Once you've calculated this using this formula, you're going to calculate your price earning ratio using this formula. Okay.
Okay.
Okay, now I'll need you guys to disconnect and then reconnect again, okay?
Okay, miss.
Because